the educational series of Genesis Volatility. Today you're going to learn about options basics. You're going to learn the difference between puts and calls, how to look at the options ladder, expiration, strike prices, premium, intrinsic versus extrinsic, the underlying, the multiplier, and the difference between buying options and selling options. So what is an option? An option is a contract between two parties that grants the buyer of the option the right, but not the obligation, to transact in the underlying asset at a specific price by a predetermined date. Now, let's break this down even further. Looking at our makeshift ladder, we can see in the upper corner that Bitcoin is the underlying asset. It's not ETH, it's not another cryptocurrency, it's not stocks, it's Bitcoin. Second thing to note is, what does one option represent? Well, in this case, one option represents one Bitcoin, so it's a one-to-one relationship. But different venues have different multipliers. So in the case of CME, one option represents 5 Bitcoin. In the case of stocks, one option represents 100 shares. Now, given that we know that the option multiplier is a one-to-one relationship with Bitcoin, and that the underlying asset is Bitcoin itself, we can now move on to the next step, choosing an expiration. Now, there's a trade-off here. The longer our option has to work out, the more upfront cost we got to pay for it. So short-dated options only have a little window to work out, and so therefore they have a cheap premium. So in this case, we can pick out the option of interest. We're going to go ahead and pick out 30 days. Now, the next step is figuring out which side of the option ladder do we want to work on. Do we want to work with puts, which gain value as the underlying asset drops? Or do we want to work with calls, which gain value as the underlying asset increases? Think about it like this. You call up a friend, or you put down a friend. That's all right. Let's go ahead and stick to the call side. So now that we've chosen a call option, the next step is going to be choosing the strike price. So this is the price that the buyer is allowed to transact at on expiration. So in this case, let's say that Bitcoin is currently trading $16,000. And the $16,000 strike price is said to be at the money. The $20,000 strike price is said to be out of the money. So because the $20,000 strike price is farther away from the current spot price, it's going to trade for a cheaper premium. But that being said, that premium is all time value. Right now, it's all extrinsic value, meaning that if we were going to expire right now, the $20,000 call is so far away from the $16,000 strike price that the call would expire worthless. On the other hand, a $14,000 call is said to have intrinsic value as well as extrinsic value. On expiration, that $14,000 call will be worth $2,000, assuming that the spot price remains at $16,000. That's $2,000 of intrinsic value. But today, that call is worth more than $2,000. It has both intrinsic and extrinsic value because there's still time for Bitcoin to go up even higher than where it is at today. So that's the trade-off of strike prices. You can buy an option or sell an option that's in the money, at the money, or out of the money. And the trade-off is the premium. Let's say that we are option buyers. We want to buy the $20,000 call that expires in 30 days. That call right now is trading for $600. At the end of 30 days, if Bitcoin spot price is at $22,000, then that call is worth $2,000 of intrinsic value. And what that means is that the seller of the option either pays out $2,000 to us, the buyer, in a cash settled option, or in something known as a physically delivered option, physically settled, the seller would basically deliver a Bitcoin worth $22,000 to us in exchange for only $20,000. Hence, the $2,000 profit remains intact. So, what about the seller's perspective? From the seller's perspective, they get to earn the $600 upfront, in hopes that Bitcoin remains where it is, goes lower, or even if it goes up from $16,000, doesn't quite get to $20,000. If it gets to $20,000 and $20,600, that's considered a break even. We paid $600 for that option. At expiration, that option is worth $600, and the seller collected $600, and at expiration, it's only worth $600. Now, the risk profile between a seller and a buyer of options are very different. Theoretically, Bitcoin can keep going on higher and higher and higher to infinity. Now, the chances of that are infinitely small, but knowing that Bitcoin can go to infinity, the seller of the call is said to be taking infinite risk, unless somehow they hedge themselves as well. But if they're unhedged, they theoretically have an infinite risk profile. The buyer of the option can only lose the $600 that they put up. On a probability adjusted basis, in a theoretically perfectly efficient market, the buyers and the sellers would make no net gain. Buying an option would be equally as profitable as selling an option. That is assuming it's a perfectly efficient market. But your job as a trader is to figure out opportunities where you think the market is underpricing risk or overpricing risk. And in the case of options, you can choose to buy options or sell options accordingly. Let's look at another example using a put. So right now, Bitcoin's at $16,000. And let's say we want to buy a put at $10,000. So that means that if Bitcoin were ever to go below $10,000, we could always sell Bitcoin at $10,000. So at expiration, if Bitcoin's worth $8,000, that option would be worth $2,000. If we remain at $16,000, the premium we paid for that put option would become worthless. And we would lose that premium, and the seller would get to collect and keep that premium. And so that's the difference between a put option and a call option. There's only 4 things you can do. You can buy or sell a call, or you can buy or sell a put. Those are the 4 things. In future videos, we'll talk about using multiple options to create complex strategies. That's it for GVol's Option Basics. See you next time.